Hello, Jonathan Camarda, Chief Investment Officer. It has been a wild week. So we'll kind of give you a macro top-down, what we've been doing within the strategies, and try to make some sense of the chaos that we've seen. So, where to begin? Well, let's just start. It was Fed week again. And once again, we saw as the Federal Reserve came out Wednesday and Jay Powell pulled the football out, Charlie Brown, Lucy style, and went 75 basis points where he said, several weeks ago at another meeting that he would not. So what happened? Well, of course, Wednesday the market went up, somewhat of a surreal, jubilee. And then, of course, we saw it come crashing down yesterday as the reality of what it actually means. So what is being interpreted as? Well, inflation certainly has appeared to be out of control. Energy and food prices cannot be controlled by the Fed's rate movements. And so what they're really doing is driving up the cost of everything else for most Americans, and at the same time as we are teetering into a recession. Now, that doesn't sound much like a controlled landing to me. Doesn't mean we'll have a deep recession. However, there are signs of recession, and the reason you look at that is inventories building up at Walmart, Target, and as such, which we've seen on past earnings calls. And then also recently, one of our beloved high-contributing sectors this year, energy, has certainly taken a big hit the last few days in large volume, which means the smart money has been moving out of energy. And they don't always tell you that and ring a bell at the time. However, that generally portends a potential slowdown in confluence with some other factors. So within your strategies, what have we been doing? Well, if you start to look at your strategies, you'll notice you have a high cash position, right, which works out pretty well. That was increasing really over the last couple of weeks. We've done well in energy all year long, as most of you know. However, we have cut most of that exposure out, some commodity exposure. And again, when that calls for, we'll reduce that as well. We have been short the markets on a percentage while having some long exposure to the market. However, we are overall cross strategies pretty defensive right now with in general over half the money in cash, a good percentage in shorts, some commodity exposure, and some long equity exposure, again, if things do turn around as a hedge. So what this means as we look at the terrain, it is very crazy times out there. We've never seen, credit situations that we're seeing as we see spreads widening globally. And what that means is that risk is perceived off when that happens. It's the rates for treasuries versus corporate bonds. And when you see that, essentially, it means risk off. So we're continuing to see that. Now, also in a currency standpoint, the dollar has continued to move up, which we've had in most of your strategies as well. In fact, the euro, believe it or not, is almost at parity, meaning 1-to-1 with the dollar, coming down from a lofty position over the last several years. The yen is down 33% over the last several weeks. In very select strategies, we've taken advantage of that, more aggressive strategies on the weakening yen. But what this means, again, is that it is very crazy times as far as volatility. The thing you should take comfort in that we are defensively positioned in a bear market. You never know when things are going to turn around. However, it is very, very gray out there at this stage, so we continue to move in prudence. That's all I have for this week, except to say stay frosty. We appreciate your time, your patience, and most importantly, your trust. We will continue to be eternally vigilant in serving you. And until next time, Jonathan Camarda, have a great weekend. Pleasure to serve.